How to easily outperform index investors. It is easy to outperform index investors. Why? It's because they don't really try to get index returns. They try for reasonable returns with less risk. This makes them use what I call as performance drags that typically reduce their returns by at least 1 to 3% a year. For example, they use bonds a lot. They usually invest partly in bonds, even though studies show that over 20-year periods, equities are more reliable. Equities have a lower 20-year standard deviation after inflation than bonds. They have a home country bias. They invest in Canada because it sounds safer, even though returns have been 1 to 3% per year lower than global stocks. Canada's index is not a diversified portfolio. It's a resource and financial sector fund. Canada's TSX 60 is only 3% of the world's stocks, but the second most popular for index investors. And also what I call riding the brakes. They have many ways to invest conservatively, like dividend, low volatility, or covered call ETFs. They all sound good, but they give you lower long-term returns. So, for example, the most popular all-in-one ETFs or asset allocation ETFs tend to be something like 25% bonds, 25% Canada, 25% US, 25% international. This is going to lag the world index by about 2% a year. It's not going to give you the full index return. So the asset allocation loss ratio, AALR, is an important concept. And so for this all-in-one ETF, it's about 2%. So basically that's the loss you experience in your return because of poor asset allocation. So 25% bonds is probably going to lose you about 1.25%, 1.25% per year loss over the long term. And this ETF is dramatically overweight in Canada, despite 1 to 3% lower returns in global stocks. And it's dramatically underweight the US, which is the highest growth country. So, not an effective investment at all. So other popular ETFs often have bonds, such as VGRO. You think it's a growth, but it's got bonds in it. So the goal for index investors is to get the full index return. That's a small tracking error, which is typically about 0.5% for global investors. Now, one broad index, either global or US, might be smart, but few index investors do that. They're, adding more ETFs is overweighting some area. It's not diversification. So almost all index investors have 3 or more ETFs, or they have an all-in-one ETF. Either way, it's a suboptimal allocation with lower long-term return. So I often talk to index investors, and they like the lower MER, but they don't realize that the AALR of their portfolio is much larger than the fee savings. So it's easy to outperform index investors by buying 1 or 2 ETFs. And most index investors aren't 100% equities. So easy to outperform, just buy 1 or 2 or be 100% equities. So just get the return of the global US equity index and you outperform index investors. You could use one broad index ETF or invest with fund managers that outperform. So now we invest for above index returns, so not below, but above. So with an elite portfolio that finds the world's best investors that all have 15 to 30-year track records beating the index after all fees. So most fund managers lag, but just like any field, there are some amazing people that outperform. So we try to beat the global index after all fees, including ours, so that our fee-for-service financial planning advice is purely value added. So index investors cannot beat the index, but our portfolio manager does. So don't invest for reasonable returns with less risk. Invest for maximum reliable long-term total return. So details, if you want more details of this, or you want to see a bunch of figures that support this, just go to last week's full post on this topic on my blog, edrempel.com. It's the #1 blog in Canada for a financial planner. If you're interested in talking with us, go to www.edrempel.com/talk. Thanks for listening, and we'll see you next week.